Bien, vamos entonces ahora a hablar sobre tendencias recientes en la sostenibilidad corporativa como catalizador de las inversiones de los grandes gestores de activos globales. Así se llama la participación o la intervención de nuestra próxima invitada especial. Les estoy hablando de Beth Byington, Global Head of ESG and Climate Solutions, the MSCI. So, Beth, thank you for being here with us. Welcome, and please go ahead.
Well, hello. As mentioned, I'm Beth Byington from MSCI, where I head our ESG and climate solutions for corporates and corporate advisors. And I really couldn't be more thrilled to be here in light of the announcement earlier today about the partnership between NUAM and MSCI, and to be part of this broader initiative to facilitate greater global investment in the region. I've been a part of our index division for many years, but about 3 years ago moved into our sustainability division because we are seeing such tremendous growth in global investment, leveraging ESG and climate data and research to make investment decisions. So that's my goal for today, is to share with you some of the insights that we have, having a really unique perspective working with over 3,000 of the largest global investors in the world. When it comes to sustainability, what are they looking for? What's top of mind for them? And what's some of the research and the data they're looking at that shows a strong correlation between ESG and strong long-term company performance? So I'll do that in a few ways. First, I'll introduce MSCI, although we had a bit of that before, but just to set some ground context. And then I'm going to share with you the results of a large survey that we recently conducted in collaboration with Stanford University, where we asked some of the largest global investors in the world to tell us about how much ESG and climate considerations play in their investment decision-making process. And we found some really sometimes affirming, sometimes surprising reactions and responses that I'll share with you. And then finally, around ESG and performance. There's been a lot of talk around ESG investing in sustainability, but what does the data show us about correlations between long-term stock performance that gives us the confidence, and really the global investor community confidence, that incorporating ESG more systematically is the right thing to do. In terms of MSCI, just again for those who are less familiar, as we discussed earlier, we're best known for being a global index provider. But as my colleague George mentioned earlier, we sit and really at a privileged place working with the largest global investors in the world, helping and providing them tools for portfolio construction, research, and data, both across public assets, private assets, and sustainability and climate is where I sit today. And as part of that, who is MSCI ESG? We are one of the largest providers of environmental, social, and governance research in the world. One of the things that really stands out is we have over 400 analysts across the world that help put this ESG content and ratings together, which is really important in order to make sure when it comes to ESG, we know that it's important to set global standards, but it's also very important to understand and reflect local considerations, local regulations, local governance practices. And so that's something that the investors that we work with also very much value and put an emphasis on. We rate over 17,000 companies and produce over 1,500 indexes. So, truly a global presence. And one thing just to keep in mind when we talk about ESG, investors often, you hear, will rely on ratings and rankings. MSCI is one of the leading rating providers. We do that on a AAA to CCC scale, so we're looking at companies and how well they're managing their environmental, social, and governance exposures. And so I raise this because, again, when we think about how investors are looking at and comparing companies in their portfolios, they're using this type of a framework, which importantly, on the right-hand side, you can see it's very much focused on financial materiality. We're looking to see how a certain company's environmental, social, and governance exposures is going to have an impact on the bottom line. We also, importantly, as part of this process, about 2/3 of the inputs into these ratings and data come from a company's disclosures. So let's say mandatory disclosures or other voluntary disclosures, such as CSR reports, but also from large amounts of other alternative data. Because again, what we hear from the global investment community is they're not looking for a check the box. They're really looking for companies and providers such as MSCI to provide a holistic view on how well companies are managing these exposures. And in terms of the process, what is the framework that we see investors continue to leverage and use when they're analyzing a company and its ability to manage its ESG exposures? And it follows this pattern you can see on the screen. First, all global investors place very strong emphasis on the governance pillar, and that would stand to reason. How is the senior management team organized? At the end of the day, these are the executives in charge of implementing the appropriate policies and procedures to manage their ESG exposures. So that's a critical piece. From there, what other risks does the company face? So is it a large utilities company that needs to think about water stress and other toxic emissions? Is it a retail company that needs to think about its labor force? There's a wide variety of ESG issues that come to apply based on the company's operations. So an understanding and a consistent application of that framework is very important. And then we look at, well, what does the company say? What are the policies a company has in place to manage those exposures? And then what do they do? And this is where we're looking at both those alternative data sources I mentioned, but also track records. And this is something I would really emphasize that investors are digging into now more than we've ever seen around companies and their track records in terms of setting targets and goals around ESG themes and how well they're on track and how much they're communicating about how well they're doing on that front. And then the final piece here is just to emphasize that the assets now tracking ESG and climate investing are significant. We have seen just at MSCI, what we're showing on the screen on the left-hand side is over $850 billion in assets now track MSCI's ESG and climate indexes, which is to say that global investors are using this type of information on a systematic basis in order to help make portfolio decisions. And what you see on the bottom right-hand side is how that number has grown over time. And you can see that growing from around just shy of 400 billion at the end of 2020 now to over 856 billion in just 4 years' time is a massive amount of growth. And so we hear a lot about ESG. Well, it's certainly numbers like this that reinforce why, because that's where a lot of the money is gravitating towards. So I set that as the groundwork, and now I want to turn to the survey that I mentioned in collaboration with Stanford University, where we went and we surveyed some of the largest global investors in the world, more than half of which manage over $250 billion in assets. And we wanted to ask them, how are they using ESG, how deeply integrated it is into their process, and what insights would that provide us? So the first thing we wanted to show here was really how important is sustainability criteria to your overall investment decisions. And so you can see here we split that across respondents from Europe, from North America, and then all respondents. And what's really striking here is how much there were 70% of European investors or 60% of investors who found sustainability as either very important or extremely important to their investment process. So that was an important place to start, and I think, again, really affirms how broadly and deeply sustainability criteria now are to the global investment process. And when we talk to these investors and we ask, well, what are some of the underlying motivations, there's a variety that we see. You can see listed here. Certainly, part of it has to do with regulation requirements or specific client mandates that are looking for certain tilting to certain environmental and social factors. But more even these days, we're seeing many more investors developing dedicated climate strategies. They're looking at the emissions of the companies they invest in. How well are companies managing climate-related risks? Or the broader category of ESG integration, right? As an investor, I look at ESG information as important additional data points and information to help me make my investment decisions. We also asked, to what extent do you consider ESG factors? How systematic, how frequently? And here we find that 2/3 of respondents say that it's one among many factors that they look at, but even more so, 20% said that it was something they explicitly look at in investment decision making. And so again, an interesting and I think affirming data point of how broadly ESG considerations are being used. I think what I also found interesting in looking at this slide was it does talk to some of the regional differences that we see. Certainly in Europe, for example, when we look at explicit incorporation of ESG, we see a relatively higher proportion of 32%, which makes sense given how long the European investment community has looked at sustainability. But I think, interestingly, in the United States, we see quite a large percentage who are using it as one of many criteria, which, if you read the headlines, and as someone who's based in the United States, there's been a lot of discussion around ESG, but when we talk to global investors and we ask them about what they do day to day, they remain committed in terms of incorporating ESG and climate considerations to make decisions on which companies to invest in. And then another, I think, important takeaway is we asked how they feel that ESG is having an impact on their performance of their investment. And here again, very strong responses that they find sustainability helps them reduce risk and volatility of their investments, which very much aligns with other empirical evidence we have to that fact, but also that it helps improve Sharpe ratio and alpha generation. So again, right, strong story in favor of what's on the top of investors' minds about why they're prioritizing ESG. The final question here with respect to ESG is we asked them, it's a bit hard to see, but on the left-hand side we asked, do you see ESG as an absolute? Is it a single framework that you apply to all companies, or do you think that it's industry specific? And overwhelmingly, the response is they do find it industry specific, but almost 80% of respondents felt that way. And interestingly, so do we at MSCI, and this is very much something we hear from our investor clients as well, is that you can see here, for example, I included some of the ratings profiles we have for some local companies where for a utilities company like Enel, we're looking at things like water stress, like toxic emissions and waste. Whereas for a retail company like Falabella, we're looking at labor management, we're looking at product carbon footprint. Different companies have different exposure space, and they should be measured as such. And really what the data will show is that has a much more powerful predictive power on the performance of the company over time. Now, taking all of this information, what I think is also important to share is more generally, what are the types of approaches that we see these investors taking when they're incorporating sustainability into their processes? And it tends to fall into one of the three camps. The first is the values-based investing. And this is really, in fact, where ESG started, around screening out certain factors, maybe certain controversial business activities or other client mandates, where it's less about financial returns and more about values alignment. Then we started to see an evolution into impact investment, much more about using capital to drive social change. Always looking for financial returns, but a more balanced view about how they can initiate change in the broader economy and communities. And then the third, and this is again the area where we're seeing the fastest growth in recent years, is purely ESG integration, where portfolio managers of all types are looking at ESG data as additional factors to help them make decisions. And here very much the focus is on achieving superior long-term performance And that, I think, is really what has been one of the significant shifts that we've seen, because investors are now asking all types of companies about their sustainability plans and strategies because of the growth of these types of strategies. One of the other important things to just share with this group is that when we look and we work with investors that are integrating ESG considerations, they tend to follow a similar pattern. So as you can see here, most often we're working with investors that are, first of all, setting objectives and policies. What are the areas within ESG that we want to focus on? What sort of targets do we want to set? Are we going to be global? Are we going to be local? And then from there, it's really about systematizing those processes into everyday decisions, into the tools that they're using, into the risk management processes. And then finally, it's about engagement. And that's where I'm sure for many of you from the corporate segment in the audience know that investors are increasingly asking about ESG exposures and really using this information to help engage companies and drive change. And it would follow as well, at a firm like MSCI, you can see that even the solutions that we provide investors, just to give you a lens into that, is very much aligned with these different investment profiles. So I think also important for when companies that we speak with to be aware of these distinct types of approaches, to be able to prepare for that based on the investors that you're engaging with. So one of the things that it's also worth underscoring here is that when it comes to the companies, they are responding. So we've seen this significant shift in assets and growth by the investor community towards environmental and social governance themes and companies that manage that well. And we see that the companies are much more engaged than we've ever seen on these topics as well. And one of the ways that we look at this is what's demonstrating on the screen here. We, as an ESG ratings provider, have thousands of companies that will come to us per year to get engaged on ESG, to share data with us. And what we look at on the charts on the left-hand side are the number of large and mid-cap companies around the world that are engaging with MSCI. And then on the right-hand side, the same information but including small caps. And the main takeaway here is that within a really short amount of time, only since 2015, the engagement rates hovered over 10 to 20% and now have reached at least half the market or more. So, companies are disclosing more. They're much more engaged than they've ever been. They're clearly being asked by their investor base to have strategies and answers in place. And I think this is also important for companies that have not yet engaged to be aware that this is the trend and how important it is to be thoughtful about the company's own ESG exposures and how they're going to be positioned, because most likely their peers in other industry organizations will already be well on their way in disclosing this information. One of the other things that we're able to do with this information that I think is important for this audience to be aware is that when we look at what are companies engaging on, we can see some pretty interesting statistics. So what you see on the slide here are the top 10 themes where we see companies engaging with us around ESG issues. And certainly the most striking part of the chart is on the left-hand side, where we've seen the number of companies engaging on climate-related themes jump significantly in the last few years. In particular, submitting around 10,000 climate-related data points to a firm like MSCI. As of last year, that topped 30,000. So just incredible growth. We've never seen this type of growth. So again, just underscoring how engaged companies are on these issues, that investors are demanding more transparency, and there's much more data in the market. We also see high engagement rates on things like human capital, labor management, corporate governance, and I think importantly too, we see recently an increase in natural capital, meaning we're seeing many more companies talk about biodiversity is really one of the newer but fast-growing areas within climate where we see companies disclosing, but also investors getting much more interested on how companies are managing the biodiversity-related exposures. And the just final slide on this section is we actually looked at within the region itself, within the companies across Colombia, Chile, and Peru that engage with MSCI, what are the ESG themes that they are most engaged on? And you can see here it follows some similar trends that we saw, certainly a focus on labor management and human capital development, but also other environmental themes like water stress, toxic emissions, and waste. And then also you see a couple things here related to consumer financial protection and the like, really reflecting some of the issues that relate to financials companies, large financials companies in the region. But in general, very strong engagement that we've seen from the region. So one of the other things that we wanted to look at in the survey was beyond ESG and really had to do specifically with climate. And I think of the survey findings, this was the other area where we were surprised about how many respondents really focused in on climate independent of ESG as an issue top on their minds. So in one of the questions, we asked, where are companies, what sort of key issues are they most focused on? And the one that came up the most frequently related to climate change and carbon emissions. 78% of respondents said that climate was among the key issues they focus on the most, which I think is really a dramatic change. And if we had done this poll just 3 years ago, it would have been a very different story. Beyond that, most frequently cited, many of them are governance-related metrics, but then interestingly, quite a high response rate on privacy and data security. Certainly with the advent of artificial intelligence, a lot more investors are looking at how well companies are prepared to manage their data online and what that will mean. And then on these questions, on the left-hand side, it was even more striking, I would say, in how much investors are looking at climate as its own subject. When we asked, what of these issues do we think will have the greatest impact on your portfolio over the next 2 to 5 years? Almost all respondents said climate change was going to be the key issue that would have the biggest impact on their portfolio in the next 2 to 5 years. And then on the right-hand side, when we asked, well, how much do you think climate change is priced into your portfolio companies today? Only 4% said that it was mostly factored in, which really goes to show that, or suggest that we should expect a significant asset repricing in the coming years related to climate change as companies disclose more, as regulations become more intense, as investors want to move faster to see their portfolio companies decarbonize further, but also a great opportunity for new green investments to come into play, whether that be green bonds or other sustainability debt vehicles. Investors are very keen to see companies transitioning to a lower carbon economy, and so that presents some great market opportunities. We also asked them within the climate, what are you most focused on? And here, probably not surprisingly, but almost 90% of respondents said they're focused on carbon emissions. That is by far the area where they're most focused. But then beyond that, certainly on companies that are broadening their use of renewable energies and new technologies. And then also top of mind is all the climate-related regulation that's coming out globally, or reporting standards like what we see from the International Sustainability Standards Board is very much top of mind for these investors as well. And a couple of other points worth sharing when we look at the data and the research is that companies are disclosing much more than we've ever seen around climate. On the left-hand side, you can see that we're tracking the number of companies submitting or disclosing, I should say, their carbon emissions of their own operations and of their supply chain. And on the right-hand side, how many companies are setting targets to decarbonize. So these are metrics that we see our investor clients very much looking at, understanding which companies are leading the way in terms of disclosing climate-related data, setting targets, and then have a track record to be able to meet those. So on the one hand, these statistics are encouraging. You can see companies are more and more disclosing this information, which investors need in order to be able to use these for decisions. On the other hand, still only about 50% of listed companies disclose or have any type of carbon targets. So still a lot of work to do. And we expect these trends to continue, but it has flattened a bit. So that's certainly something that our investor clients are looking at very closely. One of the other metrics that we see investors looking at is what we call our implied temperature rise metric, which really the most important thing to take away from this slide is that when we look at all the listed companies, those 17,000 companies, we find that despite the progress that we see, it's still not enough. That in fact, most companies' current emissions trajectories have us reaching a 2-degree warming alignment, which per past United Nations conferences is really an important threshold after which we expect climate disasters to get much more intense. So I think the biggest takeaway here is just, again, to emphasize how much investors are looking at this data in order to identify which companies are leading in the transition, which ones are setting the more aggressive targets, and which ones are showing sufficient performance in order to reach those. One final point on climate. For those who might be familiar with the carbon markets, this is another emerging area where investors we speak with are very interested to understand not only how well companies are managing climate exposures, but are they purchasing carbon credits, which are typically projects that a company can buy to help either avoid emissions, such as reforestation projects, or invest in new technologies. And interestingly, we see that companies that, on average, historically have purchased carbon credits decarbonize twice as fast as those that do not. And so, again, I emphasize this because even though it's still a relatively young market, it's something that investors are very much looking at as we look for any ways to help mitigate negative climate-related events, but also to see who's on the forefront in terms of being creative and innovative in terms of managing climate exposures. So the final section I wanted to share today had to do with the research. We talked about why investors think ESG is important, but what does the data and the research they're using show to give them the confidence to incorporate ESG into their decisions? And one of the important things to emphasize to this group is that we've seen the evolution of research in this area change significantly just within the past few years. At MSCI, we started around 2017 to create what we call the Foundations of ESG Investment, where we looked at how often companies with strong sustainability performance have better returns, lower cost of capital. But that research has continued to evolve, and I think it just goes to show how exciting this field is, but also how challenging, because the data is still being disclosed. There's a lot more we're learning, and we're also seeing the use cases change. I'd say in 2017, many of the investors we spoke with would just look at some of the simple scores, the top-level ratings, but the sophistication of how investors are using this data has grown significantly, where they're looking at very small data points, really how companies are managing across E, S, and G, which I think creates great opportunities actually for companies to be able to tell their story in a more unique way to the company rather than through a one-size-fits-all model. And so there was three key questions that I'd say come up most often that this research went to show. First of all was, do ESG characteristics affect a company's financial performance? And so in order to do this, what we did is we took the 17,000 companies that I mentioned earlier, and we put them into 5 quintiles. with the first quintile being companies with the lowest ESG ratings, so for example, the triple Cs, and then quintile 5, the highest rated companies, the ones that we have assessed are doing the best. And what you can see here is that when it comes to both gross profitability and dividend yield, companies with the highest ESG ratings had a strong correlation between high profitability and high dividend yields. And so what's great about this is intuitively that makes sense, right? Companies with strong ESG practices tend to have strong governance, they tend to be more profitable, they tend to have really strong long-term strategic plans, but it's always important to look at it based on the data itself. And so that's what this report went to show, and is something that, again, the investors we speak with rely on heavily to give them that confidence to systematically incorporate ESG into their decisions. We also took those same quintiles and we looked at, well, companies that have strong ESG ratings and programs, how does that impact their stock performance? And again, here we found that it has a strong positive correlation. Companies with the highest levels of ESG management outperform over the long term. And I think what's also important here on the chart is we looked at this both across those top-level ratings as well as the individual environmental, social, and governance pillars, and actually found that companies that had a combination of scores actually tended to perform the best, which suggests then that companies that are managing these exposures well across the board, not just one individually, tend to do better. So again, a really interesting combination of factors that I know our researchers are looking into further right now. And the final study worth sharing is around cost of capital. And this is again where the research has found companies that manage ESG exposures well tend to have lower costs of capital. On average, about 6.8% versus those with lower ratings at 7.9%. And again, intuitively, this makes sense. Companies with strong ESG ratings tend to have lower incidence of fraud, less incidents, less corruption, things that would have a negative impact on the company's performance. And it's important to see in the data that, again, that's what we find as well in practice. So just the last few slides, it's worth mentioning, or I think the thing to underscore is we feel at MSCI that investor usage of ESG is now very entrenched. There's a lot of interest in terms of continuing to access more data and engage with companies, and yet at the same time, it is still an evolving field. One of the ways that we're helping our clients, as well as all market participants, is through our Sustainability Institute, where we assembled over 3,000 research papers that I encourage all of you to take a look at, which help make sure how to stay current on top of all of these issues and to be at the forefront of what investors are looking at. Very much dominated by papers around risk and performance, and importantly, climate. And in the last few slides, there's a couple of papers that we highlight, in particular around ESG and impact on a company's stock performance, diversity and inclusion. I mean, there's a wealth of information there. And then finally on climate, and I think the one thing I would emphasize here is actually the third paper listed here. Many of our investor clients today are looking at what is the preferential way to invest to fund a greener economy. Is it to divest from companies with high emissions, or to invest into companies with high emissions in order to help with the climate transition? And I think very much the emphasis these days is on the latter, where investors are very eager to help support companies in the climate transition, again, through direct ownership, through purchasing of sustainability debt and other types of vehicles to help companies fund that transition, because it will take a significant amount of capital to do so. And with that, I will conclude, and happy to answer any questions afterwards, but hopefully have shared with you some key insights that you can take away about the depth and breadth of how ESG is being leveraged through the investment community and how that presents real opportunities for companies to engage further. Thank you.